A long straddle is an options trading strategy. It involves buying both a call option and a put option with the same strike price and expiration date. This strategy is employed when traders anticipate significant price movements in the underlying asset, but are uncertain about the direction. The goal is to profit from the volatility. For instance, if a stock is trading at $100, a trader might buy a call option with a strike price of $100 and a put option with the same strike price. Both options would have the same expiration date. If the stock price moves significantly higher or lower than $100 before the expiration date, one of the options will generate a profit. This strategy allows traders to capitalize on volatility regardless of the price direction. It's important to note that for the strategy to be profitable, the price move must be substantial enough to offset the cost of purchasing both options. The VIX, often referred to as the fear gauge, is an index that measures the expected volatility of the S&P 500 index. It reflects the market's sentiment about future price fluctuations. A higher VIX indicates greater expected volatility, while a lower VIX suggests a calmer market. The VIX is crucial for long straddle traders because it provides insights into potential price swings. When the VIX is high, implying heightened fear and uncertainty, the premiums for options increase. This is because traders are willing to pay more for the potential to profit from larger price swings. Long straddles tend to be more effective in environments with high expected volatility. A high VIX indicates a higher probability of significant price movements, increasing the likelihood of one or both options becoming profitable. Conversely, when the VIX is low, options premiums are cheaper, but the potential for large price movements diminishes, making it challenging for the straddle to generate substantial profits. Let's illustrate the concept of a long straddle with a practical example. Imagine a scenario where a pharmaceutical company is about to release the results of a crucial drug trial. The market is uncertain about the outcome, leading to increased volatility in the company's stock price. A trader, anticipating a significant price move but unsure about the direction, decides to implement a long straddle strategy. Let's assume the stock is currently trading at $50. The trader buys a call option with a strike price of $50 and a put option with the same strike price, both expiring in 1 month. If the drug trial results are positive and the stock price surges to $60, the call option will be profitable, offsetting the cost of both options and generating a net profit. Conversely, if the results are negative and the stock plummets to $40, the put option will become profitable, achieving a similar outcome. This example demonstrates how a long straddle allows traders to profit from substantial price movements, regardless of whether the market moves up or down. The key lies in identifying situations with a high probability of significant price fluctuations. While a long straddle can be a powerful strategy, it's crucial to acknowledge the inherent risks. One of the primary risks is the potential for the underlying asset to remain range-bound. If the price doesn't move significantly in either direction, both the call and put options might expire worthless, resulting in a loss for the trader. To mitigate potential losses, traders often employ strategies such as setting stop-loss orders or implementing adjustments to the position. A stop-loss order is an instruction to automatically sell the options if the price moves against the trade beyond a predetermined level. This helps limit potential losses. Adjustments to the position might involve rolling the options to a later expiration date or adjusting the strike prices. These adjustments aim to reduce the cost of the straddle or capitalize on changes in market conditions. It's important to note that adjustments come with their own risks and require careful consideration. Section 5. The role of option Greeks in long straddle. Option Greeks are essential tools for evaluating and managing options trades, including long straddles. They provide insights into how the price of an option is affected by various factors. Let's focus on 2 key Greeks relevant to long straddles: theta and vega. Theta represents the rate of time decay of an option's premium. Options lose value as time passes, and theta quantifies this decay. Long straddles are time-sensitive strategies because they involve buying 2 options, both of which experience time decay. Traders need to factor in theta and ensure that the potential profit from a price move outweighs the time decay cost. Vega, on the other hand, measures an option's sensitivity to changes in implied volatility. As mentioned earlier, long straddles thrive in environments with high volatility. A higher vega indicates that the options price will be more responsive to changes in implied volatility. Traders need to monitor vega closely and adjust their positions if the implied volatility doesn't align with their expectations. Section 6. Timing the entry. When to embrace the straddle. Timing the entry point is crucial for any options trading strategy, and long straddles are no exception. While high volatility environments are generally favorable for long straddles, pinpointing the optimal entry point requires careful consideration of various factors. One approach is to look for periods of compressed volatility. When volatility is unusually low, options premiums tend to be cheaper, providing a more favorable entry point for a long straddle. If a catalyst is on the horizon, such as an earnings announcement or a major economic release, the compressed volatility might be a precursor to a significant price move. Another factor to consider is the overall market sentiment. Extreme fear or euphoria can create opportunities for long straddles. For instance, if a market correction is widely anticipated, a long straddle on a broad market index might prove profitable. Section 7. Exit strategies for long straddle in Indian market. Exit strategies are as crucial as entry strategies in options trading. The Indian market, with its unique characteristics, necessitates specific considerations for exiting long straddle positions. One common exit strategy is to set profit targets for both the call and put options. Once the desired profit level is reached on either leg of the straddle, traders might choose to close that particular option while letting the other ride in case of further price movement. This locks in some profit while maintaining the potential for additional gains. Another strategy is to implement a time-based exit. As options approach their expiration date, time decay accelerates, eroding the value of the straddle. Traders might decide to exit the position before a certain date, regardless of the profit or loss, to avoid the risk of losing a significant portion of their premium to time decay. Section 8. Key takeaways from today's lesson. A long straddle involving buying both call and put options aims to profit from significant price movements in either direction. The VIX, reflecting market volatility, guides traders on the suitability of this strategy. Traders utilize stop-loss orders and adjustments to manage potential losses. Understanding option Greeks, especially theta and vega, is crucial for evaluating the impact of time decay and volatility changes. Timing the entry, ideally during periods of compressed volatility or extreme market sentiment, is essential. Finally, exit strategies in the Indian market often involve setting profit targets or employing time-based exits to protect profits and mitigate losses. By mastering these concepts, traders can effectively implement and manage long straddle positions.